Hello my fellow freedom builders and welcome back to the channel. Now today's video is about Chinese stocks and I've gotten a lot of questions about why are they dropping, are they coming back, when is the right time to buy some of these major Chinese names like Alibaba and Tencent and Baidu and all the companies that many of you mention. And today I'll take a look at it because investing in China, when you do that, you're poised to take some risk that many investors are actually not aware of. So I'll try to tell you a bit about these risks today, and then you can decide for yourself. And I'm not claiming that I'm an expert on Chinese investment laws, but there are some dangers investing in Chinese stocks that you need to know. And then you can decide for yourself if you think that it is worth the risk or if you would rather invest in some other Western-based companies, but let's have a look at it. First of all, here we have the Chinese Hang Seng index, and when we have seen the stock markets lately, the last month, we have just seen stock markets go up and up and up here in the United States and Europe. But if we take here from the top in February in the Chinese market, then we are down close to 20% right now. And today I'll try and have a look at why that is, because there are some explanations, there are some reasons that are making the investors quite nervous right now. First of all, let's just give a quick thank to NSB, the broker that is sponsoring this channel for this time. And they are a Forex commodity broker. I'll tell you a bit about them later in the video, but they are the main sponsor on my channel as of this moment. All right, let's have a look at some of the dangers in investing in these Chinese stocks. First of all, what you should be aware of is that the accounting principles in China, the laws around accounting, is not exactly the same as we are used to here in the Western countries, United States and Europe. It is getting better. Just 5-10 years ago, it was a lot harder to see what was actually the revenue of a company. But I just took an example here with Luckin Coffee. A couple of years ago, when I started my channel, I started telling about this Luckin Coffee and said that something was completely wrong, and we could see it on the chart that it was a good sell candidate, maybe even a short candidate. And people got very upset because Luckin Coffee was the Starbucks of China and so on. And that's fair enough. The problem is that the revenue numbers that we got from Luckin Coffee was completely made up. And due to the legislation in China, it simply didn't, it wasn't obvious to people until very late in the process where the company was just weeks away from bankrupt. So there was a lot of fraud going on in Luckin Coffee, and there were not enough ways to find that out when it comes to the accounting principles in China. That is one thing, but that's actually not what worries me the most with Chinese stocks. Now, what worries me the most is actually that the Chinese market, when you're looking at the investment laws in China, it is, in broad terms, it is not it's not legal for a company in China to sell a major chunk of the shares to a US investor. Meaning, here we're especially talking about tech companies, innovative companies, and so on. But basically, a Chinese-based stock company on the Chinese stock exchange, they cannot just go out and sell a large chunk of the stocks to happy investors from United States or Europe. You might think that is the case because you're thinking, well, I own a chunk of stocks in Tencent or Baidu or whatever stock that is. But you're actually not. So let's have a look at some graphics I've found here this is from the Bloomberg.com. I found this, so no reason in drawing it myself. They did all the work for me here. First of all, we have here some Chinese, let's just have a look at, we have some, see if we can find the right tool here. We have some Chinese owners of a Chinese company here, and they want to get some capital, some funding in from foreign investors. But the problem is that the foreign investors out here, they are prohibited from just buying a chunk of this Chinese company. So what they do, the Chinese company, is that they register a foreign shell company. That is something called a VIE, and that stands for Variable Interest Entity. They start such a VIE on, for instance, the Cayman Island. That is a shell company. You buying a part of that shell company, you don't own a part of the original company, because what happens between these two companies is that the Chinese company they make a contract with the shell company so that the revenue from the company should go to the shell company, meaning that if they are making $1 billion and let's say it was all foreign investors owning this, they owned 100% of the company via the shell company here, then all the revenue should go to that shell company and the foreign investors are getting the money. However, they are not owning the company. They don't have any deciding votes on the board. They don't own any assets. And when you're looking at the signals from Beijing, from the government, they actually don't like this structure here. And they have been talking a bit about maybe closing it down. If that happens, you could take all the money here that has gone into the Chinese company and you can simply wave goodbye to them. Because if Beijing closes this structure down, then all the foreign investors are actually owning is shares in an empty shell company sitting on Cayman Island. They're not owning the machines, they're not owning the tech, they're not owning the patents, they're not owning anything in the Chinese company. They're just owning parts of this shell company. So right now, fair enough, they have been getting the revenues here, but many of the investors, especially the private investors, but actually also some quite large investors, they either don't know that they only own a part of a shell company, or they are not completely aware of the actual risk at stake here. I talked about this in a video a couple of years ago actually, and said that I thought it was completely insane that people poured so much money into these shell companies on Cayman Islands, these VIEs here, without considering the risk that China might, maybe in a trade war with the United States, maybe just as a part of their communistic thought process, saying that, yeah, well, the foreign investors should not make money on our tech, so we are simply closing the entire structure down. Now, I know that many analysts are saying, yeah, they can't afford it. China can't afford it. They need our money. And yes, that might be true. But just be aware of the risk, because when people are assessing a Chinese company, they are only looking at the growth of sales, the growth of revenues, and so on, and they are trying to price it out of that as if it was just a normal Western company, and they were just taking the same sort of risk that they would in a Western company on the stock exchange. But what there actually is there's a huge risk involved in this, that they can actually lose their entire stake of money, and the company will still be running, but in China and without the foreign investors. So I'll put some link underneath the video. If we just take a look at here, I just found by a quick search how China played American investors. This is from Wall Street Journal. Then we have the Financial Times here. Beijing's threat to VIEs triggers Wall Street's angst over China's stocks. We have a crackdown on US listings. Will China close $1.6 trillion VIE loophole? They'll probably not close it completely down, but they might make it a lot more tough for foreign investors to get money out. And here you can see variable interest entities used by, for instance, Alibaba and Didi and a lot of other companies. Hong Kong, will the VIE structure die? What Hong Kong and Alibaba have in common, and so on and so forth. You can find all of these articles. They're all over the place right now, but they should have been all over the place for the last 5 or 10 years, because this is actually a problem that should have been talked about a lot earlier. Anyway, that is how it is. If we look at some of the companies, I just made a quick list here. We have JD.com, which is a fantastic growth story. And I should say, for instance, now I made a video about ARK Invest the other day. And ARK Invest have been one of the large fans of Chinese stocks, but they actually went out not long ago selling all of their Chinese shares. And then all of a sudden the other day they started buying again. And I'm not really sure why. Maybe they thought they were getting so cheap that they needed them back in the portfolio. But nothing has really changed in the picture from the governmental point of view in China, as far as I can tell. So I don't really understand why ARK Invest started buying some Chinese stocks again. I understood why they went out, but I'm not really sure why they're going in. Maybe they know something that I don't. Now, if we look at JD.com, just with my normal technical point of view here, you can see a very nice trend. We can draw a regression channel from down here, and at some point up here around 85 or something like that, I would have gotten a sell signal and I would have been out of the stock. Right now it is in red and yellow zone, and it might go back to green again, and it might be possible to buy it according to my rules, but I won't. And I haven't been buying any of these Chinese stocks because I was not willing to take this risk with the VIEs. Yeah. We have Alibaba Group here, as you can see, from a top at 300 and something up here, 1520. And again, when would I have sold here? Breakdown on the 20 SMA. I might have sold it here around 270. I might have waited until 260 here. But we can see all the indicators and the price action when we compare the price to the 20 SMA. That's my normal way of investing here. That would make me leave the company completely up around 260, 270 up here. And since then, it has just been going down, down, down. And then some of your questions are, of course, when will it be time to enter these sorts of stocks again? First of all, as I say, I'm not entering them. I have not been in these stocks at all. But if you were looking at the stock with my glasses here, my trading strategy, it would take a lot. They would have to start outperforming the market. Now, this is Alibaba compared to the SPY. It is a Chinese company, but it makes sense to compare it to the S&P 500. And it would have to start outperforming again. And you can see here, green zones, that is where we are allowed to buy. And red and yellow zones, that is a no-go for us. That is Alibaba Group. There's the Tencent company, again from a top here in 99, down somewhat around 40%. And when we look at the price action and the indicators, we can see that somewhere around here in the 80 to 85, maybe 87 level, we would definitely have gotten out of this stock. And it is down to 58, 59 right now, and I'm not certain where it goes from here. When I look at some of the different analysts, I can see that some of them are talking about maybe it's time again, maybe it's getting priced a bit better, but most of them are talking as if they were evaluating any company here and just looking at, yeah, with Tencent's earnings or Alibaba's earnings, this is getting close to good value now. And none of them, or almost none of them, are actually talking about the risk that Beijing, that the government will cancel somehow much of this variable interest entity structure. If they do that, you can say bye-bye to a lot of these companies on the Western Stock Exchange, and then you, if you own these stocks, will probably have lost your money, as far as I can tell. We have Baidu going up here from 350 down at 150 now, so they are more than cut in half, which is quite crazy. I would probably, as you can see, break down, trying to get past the 20 SMA again, bouncing on the 50 line here on the RSI. So I would definitely have been out here around 250 at least. It's exciting to see where that one is going. Pinduoduo, the same picture. Didi. Now Didi, we don't have much data on here. That's an IPO coming out a few months ago. And they pretty much IPO'd directly into this drop in the Chinese stocks. So the ones going in DD here thinking it was a great company, buying in at 17, 18, they now a couple of months later own stocks at 8.2. And I had a discussion the other day about this with another investor, and he said, yeah, well, it will come back because it's a great company. It could be the best company in the world. If China is cracking down on these VIE structures, it'll probably never come back. Then there is there's an extra layer to this, and that is several of these online educational companies. Now, the educational companies in China is a huge market, but there is something else here than just the VIE structure, because China's government were out saying that they saw it as completely immoral to make money on these online educational software and company programs. So they were actually out saying it should not be allowed to make a profit on online education. And as you can see, these are not just cut down by 30 or 40%. We have the EDU here, the New Oriental Education and Technology here. What we can see here is that from a top up here and until now, it is down something like 90%. And we can see we would have gotten, with our strategy here, we would have gotten out around 16 something here. We would have taken a 25% haircut here, but we would have avoided the rest of the drop here. There are some others, for instance, GoTo here, exactly the same picture. They were up around 150. Now they are at $2. We can see the TAL Education Group were up just around 100. They're down at $4 to $5 now. And there is the YQ here, also a recent IPO here from December 20, and they were up at 24. They are now at $1. My guess is that they are not coming back. At least not to former prices here. I shouldn't say that China's government cannot come out and communicate some sort of solution and saying, yeah, well, we do want the Western money. However, we are controlling a lot more now. I don't think, that's my guess. I don't have any inside knowledge here. But my guess is that the Chinese government, in this fight with the United States, that they are doing on a lot of fronts, on the oil front, on oil futures, on military wise, these fake islands they're putting out in the middle of the Pacific and so on. They are really attacking United States on a lot of fronts here, and this is one of them. They can really hit the Western investors extremely hard here. They already have. And they can see the desperation from the United States and European investors right now. And honestly, I think they enjoy it. This was the intention. They want to gain the control. It is still the Communist Party that is sitting on the control. And they have seen a tendency of these capitalist companies getting more and more outspoken. We saw it with the guy from Alibaba, Jack Ma, where he was outspoken. He was criticizing the government in Beijing, and all of a sudden he was pretty much taken off the street. He's still there, he's still alive, but nobody really saw him for a couple of months, and there are a lot of speculation as to what actually happened. But most people think that he were pulled back to Beijing and told a bit about how you would communicate if you were the leader of a company in Beijing. So they are really controlling it right now, and they are trying to put their foot down and saying, yeah, it's great with the tech, great with the innovation, but please guys, remember who is in charge in China, and it is not the investors. So this is the explanation why I have not been investing in Chinese stocks for a number of years. I have never done it actually, and I'm not saying you shouldn't invest in it. And there are also, of course, a lot of information that is not told in this video, but these are the core concepts. And you could invest in these companies, but please be aware of the risk and only buy when you have assessed this risk in a manner where you think that you are getting a good stock at a very cheap price where you're thinking that it is worth the risk. All right, talking about risk, if you want to use a broker for your forex trading and commodity trading where your money is not a risk, you could have a look at the NSB, the sponsor on this channel, because they have, of course, a negative account insurance so that you cannot lose more money than you have actually put into your account. They're also running with the pure ECN, so you're not risking that your broker is trading against you. And basically, they are just a very good broker for the forex, for the commodities, and for a few CFDs and stocks as well, where you're getting an extremely competitive spread and a very professional company that gives you good service. If you want to withdraw money, it is happening lightning fast. I have tested it with some money I deposited, tried to withdraw money. It is happening very, very fast. So a very solid company, very solid broker if you want to trade this. I am also starting my little hobby YouTube channel called Viking FX. I'll put a link to it below, and you can have a look at that if you are interested in seeing how I'm trading forex and commodities. That's all for now. I hope this was kind of a little educational for you as to how this Chinese stock market is actually operating and what sort of risks you are taking if you are entering it. So take care of yourself and your money out there, and I'll talk to you again shortly. Bye for now.